Hey there, everybody. Welcome to another edition of SRT Live with me, your host, Sean Richard. And the Fed comes out with a surprise last week with an increase to the Fed funds rate higher than expected. Let's dive into it today. So thanks so much for joining me. Really big information last week. You know, you've seen it all over the news. With the Fed's meeting last week, their decision to increase the Fed funds rate by 0.75%. We're going to get into that here in a little bit, but I wanted to run through some of the numbers that we normally hit. So today and yesterday, we got May existing home sales. And so existing home sales month over month, we're down 3.4%, and year over year, we're down 8.6%. Now, on the surface, this sounds like, oh man, that's not good. The housing market is declining, and that's what the media is going to run with. That's what they're going to spin and really play to their fear-mongering ways. So, what we need to take out of this, though, is we need to look at the context of what's going on in our market, in our industry right now. We've got home prices higher, we've got interest rates higher, and we've got inventory low. Now, we've seen a slight tick up in inventory here recently, but in general, we're still in a very low inventory market. So from a existing home sales, which makes up 90% of the market, the housing market in sales, from an existing home sales standpoint, we're going to see a little bit slower pace of homes as we continue to see prices rise, as we continue to see rates rise, and as we see low inventory environments. So not too much of a surprise of that coming down a little bit, but we do want to be mindful of it. We do want to watch it going forward. I don't personally think we have anything to worry about from an overall perspective, but we're going to have to see where home prices go going forward. You've heard me talk about it before. I think we're going to continue to rise. We're going to have to see where rates are going forward. I think we're going to see those rise over the course of the summer as well. And then, of course, inventory. Although we have a slight tick up right now, I think in general, we're going to see continued low inventory over the course of the summer and into the fall. All right. So last week, as always, on Thursday, we got the initial and continuing jobless claims. So this is unemployment claims. This is individuals filing for unemployment for the first time. This is a great thing to watch when you're looking at, future indicators. A big indicator of a recession is when unemployment bottoms out and starts to tick up. And so we want to watch that. And so jobless claims or unemployment claims are definitely a way to help keep on that pulse. So initial claims, our last reading from 2 weeks ago was 232,000. And remember, these are weekly readings. So these are job creation or unemployment filings for the week. So our previous reading for a couple of weeks ago was 232,000 job filing or unemployment filings. Last week, we had unemployment filings of 229,000. So right in that same range. Now, this is up from some of our recent lows that we've had. We've been under 200,000 or just a hair over 200,000 here recently. We've ticked up a little bit from that. So again, something to keep an eye on as we move forward. Then we had continuing claims, and this is individuals renewing their unemployment benefits. Our reading from a couple of weeks ago was 1.309 million. Last week we got 3.12 million. 1.312 million. So right in that same ballpark. We're seeing that at a level pace at the moment. But again, this is up from some of the levels that we, continuing claims actually is about at some of the lower levels that we've seen. They were a little bit higher early on, and those have shrank. We also got housing starts and we got building permits. And if you were on last week, you know my chair is a point of contention for me right now. I got to go get a new chair. Keeps sinking on me. I promise I'm not always that short. So housing starts are really tell us the pulse of where we're headed from an inventory standpoint, from a new build standpoint, or a new build perspective. So we got housing starts for previous month at 1.5 549 million. And so that is on a run rate of about 18 million, 18.5 million for the year. And just to put that into perspective, from 2000 to 2009 in the United States, home builders put up a little bit north of 20 million homes. And then from 2010 to 2019, home builders put up between 5 and 6 million homes. Now, that's not unexpected. After 2008, we saw a flood of foreclosure inventory make it to the market. And so there wasn't as much demand because we had a surplus of supply. And so there wasn't as much need for builders to go out and build a ton of homes. And that's actually part of why we have the shortage in inventory now, is we've got significantly more demand, but the supply never stayed steady. So we're on a pace, an annualized pace of about 18.5 million based on that last month's numbers, which is a relatively solid pace, but it doesn't help us play catch up from the lack of inventory that we have. And then we also got building permits. And so building permits, again, just gives us foresight into where inventory might be headed. So 1.695 million for the month, building permits. Again, annualized pace of right about just under 21 million. And not all of that is residential housing. Some of that is commercial. It's not all pertaining to housing inventory. So we need to keep that in mind as well. But it gives us a pulse on construction and what's going on there. All right. So the big information, obviously, last week was the Fed meeting. The Fed wrapped up their meeting on Wednesday of last week, and they decided to increase the Fed funds rate by a quarter, or by 3/4 of a basis point, 3/4 of a percent, or 75 basis points. And this is a big deal. You've heard me talk about this before, that the Fed funds rate is short-term lending rates. It's overnight lending. It's what banks use to lend to other banks on overnight levels. It impacts shorter term products. A lot of times, a lot of the media has been coming out and stating that with the Fed raising the Fed funds rate, people pay higher cost on their mortgage. And this infuriates me. I can't stand it because the media is getting it wrong. I saw a CNN headline with graphic that said, Fed increases Fed funds rate. Consumers will now be paying more on, and then it had 4 different graphics, one for auto loans, one for credit cards, one for something else, and then one for mortgage. And that could not be further from the truth. So I want to make sure that we're all working together to educate our clients, to educate consumers. The Fed funds rate is short-term lending rates, and it does not have a direct, nor usually a negative impact on long-term rates such as mortgages. When the Fed increases the Fed funds rate, in this environment, the design is to combat inflation, because inflation is the enemy of interest rates. So as inflation rises, interest rates are going to rise as well, which is why we've seen mortgage rates rise upwards of 3+% since the end of last year. So the Fed increasing the Fed funds rate is designed to help bring inflation down, which should give some relief to interest rates. Now, it's going to take time for the Fed. It's going to take time for the Fed's interest rate increases to really start to have an impact on the economy, and we're likely going to see some more rate increases going forward. So there's hope, there's light at the end of the tunnel from everyone who is maybe on the fence about buying because of where interest rates are. There's definitely some light at the end of the tunnel. However, by waiting, you're passing up on the equity growth in that home between now and then. So a 1 or 2% lower rate doesn't help out as much if you're paying $30,000, $40,000, $50,000 more for a home. And so it's really important to be able to analyze that information, take the emotion out of the decision, and really look at this market like investors are doing. Because if you notice, there's a lot of investors that are still buying up a lot of properties. And why would they be doing that if it didn't make sense based on where interest rates and home prices are? So that's something that to ask ourselves. I'm going to dive more into this here in a moment. Quick look ahead. We've got initial jobless claims on Thursday, as usual. We also hear from Jerome Powell tomorrow. And then on Friday, we get new home sales. So give us an insight into new construction sales as well. So let's dive a little bit further into the Fed meeting. Jerome Powell, affectionately known as J-Pow, had his press conference after the Fed meeting last Wednesday, and just kind of want to hit a couple of the notes that he talked about. So first and foremost, there's a 0.75% increase on the Fed funds rate. And if you have any additional questions, you want to have a conversation about that, the impact of the economy, definitely hit me up in the comments below. Don't hesitate to reach out to me at the number below right there. I'm happy to hop on a call or grab a cup of coffee and talk about it. So some notes from his press conference. He did indicate that additional rate hikes, additional rate increases may be appropriate. A 50 to 75 basis point rate increase possibly could be appropriate at their July meeting. So it's something we really want to keep an eye on come time for their meeting in July. They're definitely, he opened the door for another 75 basis point rate increase. And although, again, that has a long-term positive impact on interest rates, there's a lot of other implications in the economy. It does make borrowing more expensive in other areas. And it dampers demand. I mean, that's really the idea, is increasing the Fed funds rate dampers demand, decreases demand. We don't have a whole lot of control over supply, so it decreases demand and therefore helps stabilize price, bringing inflation down. And so he opened the door for upwards of a 75 basis point rate increase next month as well. He indicated that they need to be nimble. They've got to be able to look at the data and change their direction based on the information. They don't want to just create a plan and put the blinders on and stick to the plan regardless of what's going on in the economy. So that was positive language. It definitely let us and the market know that we're not going to see the Fed simply, go down the path that they've set for themselves, regardless of anything else that's going on. So they're open to making those changes as the data continues to improve and move in the direction that they're after. Their goal, they're focused on getting inflation back down to 2%. Now, the last CPI reading that we had showed that inflation was up at 8.6% year over year, and they're wanting to get that back down to 2%. So they got a long ways to go, and they're projecting that that's probably not going to get into that range until Alexa, stop. Oh man, perfect timing today. So they're projecting that they're not going to reach that mark until probably 2024 or the end of 2023. I think they're projecting for inflation to be back down closer to 4% by the end of this year, and further decline going through next year. So we want to watch those inflationary reports as they come out month over month. He did see a need for increase in the future. We kind of touched on that just a moment ago, but they're going to be data dependent. Was really his focus there. They're going to seriously watch the data as it comes out. What they don't want to do is they don't want to significantly thrust us into a recession in an exaggerated way. You've heard me say that we're likely going to be heading into a recession, and that could be over the next 6 to 24 months. The question is how deep of a recession, how hard of a landing, as the Fed tends to put it, will we be able to avoid going, diving headfirst into a recession, or are we going to be able to glide into a recession that's relatively shallow? And so the Fed being data dependent, open to being nimble, that definitely gives us a little bit of hope that it won't necessarily be as deep of a recession as some analysts and market commentators have referenced, but only time will tell, because the Fed does use reactionary data, lagging indicators to make their decisions a lot of times. And so it does tend to open them up to overcorrection. So we'll see how all that data pans out in the coming months. And then the biggest, the biggest data points they're looking for is he made the statement that they're looking for compelling reasons, or I'm sorry, compelling evidence that inflation is declining. And so, maybe that's gas prices coming down, maybe that's CPI, consumer price index inflation report declining. The Fed also looks at PCE, which is personal consumption expenditure, another inflationary report. They also look at that. So seeing those reports decline, seeing maybe gas prices come down, those pieces of the puzzle are going to be very important. And the Fed's got their eye on those. Again, they want to see, concrete, compelling evidence that inflation is coming down, and that's going to indicate that we're getting into a better price stabilization across the board. And then that's also going to help interest rates as that inflationary numbers come down as well. So there's a lot of pieces on the horizon that we want to keep an eye on. Inflation is obviously main focus here. There's a lot of other worldly economic events going on. We still have the Ukraine war going on, which is impacting the global economy with energy issues. We've got Shanghai over in China that's going to be opening up here pretty soon, or is in the process of opening up. When they're fully operational, that's going to put a lot more stress on energy as well. So we're likely to see energy prices increase because the demand is going to jump way up without having a significant increase in supply. So we've got other global economic factors that are at play as well. But the Fed and Jerome Powell, they're working on leveraging the monetary policy levers that they have at their disposal to try and pare back inflation and get back to price stabilization. And so I'll be back next week with more information, more data, a little bit more insight into our economic situation and how that pertains to the housing and mortgage markets. It's an interesting time. I kind of tend to geek out on these things. So we're in an interesting environment. And I hope that the information that I'm providing you, that you can pass along to your clients, is helpful and it allows you to understand what's going on in our economy and how it pertains to our market that much better. So once again, thank you so much for joining me on this edition of SRT Live. With me, your host, Sean Richard, with the Sean Richard Mortgage Team here at Guaranteed Rate. Have an incredible rest of your week, and I will talk to you next week. Take care.